All right. Can all of you hear me that's present in this class? Just give me a thumbs up if you can hear me. Awesome. Thank you, Forex Villain, for your response. Bafana, can you hear me? All right. All right. Introduction to Forex, trading. Um, Trading is about buying and selling currencies with the goal of making a profit from changes in their value due to real world events. The cool thing about this market is that it never sleeps, it's open 24/7. As the titan of global finance, Forex pulls in more trading volume than any other market and sees participation from big players like banks, government, corporations, and currency speculators. Unlike traditional stock markets with their centralized exchange, Forex trade over the counter with the major banks setting the exchange rates. It doesn't stick to the classic trading models you might be used to, which often struggles during major market shifts. Plus, the noise from those trades make it tough to predict what's going to happen at any given price. Guys, can you just mute yourselves? All right, thank you, thank you. Plus, the noise from all these trades makes it tough to predict what's going to happen at any given price. Market activity can swing widely, creating those unpredictable V-shaped patterns even when the same news is out there. Market makers provide quotes that can be somewhat random, meaning a good market event might not push price up and a bad one won't necessarily drag them down. Okay, class. So, um, what is Forex? What is Forex trading? In short, Forex trading, also known as foreign exchange trading, is the buying and selling of currency on the foreign exchange market. It involves exchanging one currency for another with the goal of earning a profit. So everybody trading Forex is in for it to actually has a goal to earn a profit from it. The, the history of Forex trading. The concept of Forex trading dates back to the ancient times. When currencies were first introduced, however, modern Forex trading began to shape in the 1970s when the Bretton Woods system was abolished and currency were allowed to float freely. Evolution of trading in the 1990s. The internet and electric trading platform sorry platforms revolutionized forex trading, making it more accessible to individual traders. Today, forex trading is a global market with a vast array of participants, including banks, hedge funds, and retail traders. So, daily trading volume. You might be wondering how much is being traded a day in the Forex market. So, the Forex market is the largest financial market in the world with a daily volume of over 6 trillion. This dwarfs the daily trading volume of the global stock market, which is around 2 trillion. Forex, major Forex trading centers. The forex market is a global market, but there are several major trading centers around the world, including London, New York, Tokyo, Sydney, and Singapore. These centers are responsible for the majority of forex trading volumes, and they operate 24 hours a day, Monday to Friday. Key players in the forex trading. These are the key players in the forex trading people. players that actually moves the market. So some of the key players in the forex trading includes the banks, hedge funds, retail traders, which are us, central banks, and corporations. These players uh, these players use the forex market to facilitate international trade, invest in foreign assets, and manage current currency risk. So the basics of forex trading, right? How does forex trading work? Currency are traded in pairs such as euro USD, which is the euro against the dollar. When you trade forex, you are speculating on the value of one currency against another. So I need you guys to understand that in this industry of forex trading, it's not a guaranteed thing that when you buy that the market will go into your direction. You are just speculating on the value of one currency against another. Example, if you buy euro USD, you are betting that the euro will strengthen against the US dollar. And if you are selling, it means that you are speculating that the dollar will strengthen against the euro. So number three, major currency pairs. There are three types of currency pairs in forex trading. You get the major pairs, the minor pairs, and the exotic pairs. So major pairs are mostly traded and highly liquid, such as your Euro USD, your USD JPY, GBP USD, and USD Swiss franc. The minor pairs are less traded but still liquid, which is your Euro GBP, AUD NZD, and GBP JPY. Your exotic pairs, it's a major currency pair with an emerging currency pair like your euro and your ZAR. Forex market participants. The forex the forex market consists of different players, including banks and financial institutions. Thus, they facilitate large transactions and set exchange rates. Retail traders, which is us, individuals who trade brokers, who trade to individuals who trade through brokers to profit from currency fluctuations. Central banks influence currency value through monetary policies and interventions. Corporations engage in forex transactions for international trade and hedging purposes. So forex trading sessions. There are namely four forex trading sessions. The forex market operates 24 hours a day, 5 days a week, divided into four main trading sessions, right? You get the Sydney session, which is from 10 p.m. to 7 a.m. South Africa Standard Time. Tokyo session, Tokyo session from 12 a.m. to 9 a.m. SAST. London session 8 a.m. to 5 p.m. SAST. New York session 2 p.m. to 11 a.m. The most active and liquid trade trading times usually occur during the overlap of the London and New York session. In forex trading, the overlap refers to the period when two or more major trading sessions are open simultaneously. During an overlap, trading volume and liquidity increases. That's when you trade London and New York. That's the overlap between London and New York, meaning that trading volumes and liquidity increases. Market volatility and price movements can become more significant. More traders and institutions are actively buying and selling. The overlap creates a unique market environment, often characterized by tighter bid and ask spreads, increased market participants, potential for more significant price movements. So when this overlap occurs in the market, the London-New York overlap, this is the time when spreads increases, Market participants become more in the market, and there's a lot of volatility happening in the market. So understanding Forex quotes. Forex quotes consist of base currency, quote currency, bid price, ask price, and you get the spread. The first currency in the pair, let's take for an example Euro USD. The base currency, the Euro, against the Euro USD, the Euro is the base currency. The quote currency is the second currency in the pair, which is USD. That is named the quote currency. The bid price is the price at which the market buys the base currency. The ask price is the price in which the market sells the base currency. I hope that makes sense to you all. The spread now, the most important part, the spread is the difference between the bid and the ask price, representing the broker's profit. So there's profit that the broker that you are using, that there's profit that the broker that you are using is gaining. So that spread, whether you see on your MetaTrader that the spread is 5, 6, or 1, that simply means that 5 or 6 pips is gonna go to the broker, and you are actually paying for commissions towards the broker for using their platform. You understand? So example is Euro USD 1.50, Euro USD trading at 1.1050 and 1.5052. The bid price is 1.1050. You sell at this price. The ask price is 1.1052. You buy at this price, which means the spread that you pay towards your broker is only 2 pips. So number 7, types of Forex orders. You get the market order, you get the limit order, you get the stop loss order, you get the take profit order. So the market order executes at current price. The limit order executes at a specific price or better. The stop loss order closes a trade at a predetermined price to minimize losses. The take profit order closes a trade at a set profit level. So using the stop loss order and the take profit order simply means that you don't have to be active on the markets for the market to close your position. Leverage and margin. Margin is the amount of money you need to put up to open a trade. Think of it like a deposit or a down payment. Margin is usually a percentage of total trade value. I hope you understand that. Leverage. Leverage is a loan that helps you control a larger trade size. Leverage allows you to borrow money from the broker to increase your trading power. Leverage is usually expressed as a ratio like 1:100 or 1:500. Here's an example. You want to trade $1,000 worth of Euro USD. Your broker requires a margin of 2%. You need to put up $200, which is 2% of $10,000 as margin. With a 1:100 leverage, your $200 margin controls a $20,000 trade size. So remember now, higher leverage means higher potential gains, but also higher potential losses. So the higher your leverage, the more you can make in the market or the more you can lose in the market. It's essential to use leverage wisely and manage your trade carefully. Forex trading strategies. So there are about 4 type of strategies in the Forex trading market. It's either you're a scalper, you're a day trader, a swing trader, or you're a position trader. So if you are a scalper, that means you take short-term trades held for seconds or minutes, meaning you are just in and out in the market. Day trading, which is what we do here at Boldfx Academy, we we close trades within the same day. So if you are a swing trader, you hold trades for more days and weeks. If you are a position trader, you hold trades for long-term trading based on fundamental analysis. So risk management. Risk management is key to Forex trading. You have to know how much you risk before you enter a trade. So this is a key note on your notes. Put hereby risk management NB because this is one of the most uh, important things of trading the financial market or trading the Forex market actually. So risk management is all about setting a stop loss order to limit potential losses. Use proper position sizing in manage. Use proper position sizing to manage risk exposure. Avoid over leveraging to protect your capital. Stay updated on economic news that impacts the forex market. So please take note of the risk management because all of this will play an essential role in your in your journey of trading, right? So please do take note of this. It will help you a lot, especially in managing your account. So market structure, right? Market structure in forex trading refers to how price moves in a structured manner, forming patterns that traders use to analyze trends and make informed trading decisions. It helps traders understand the current phase of the market, whether it's trending, it's ranging, or it's transitioning so that they can adapt their strategies accordingly. Types of market structure. You get an uptrend, which is called a bullish market. Price makes higher highs and higher lows. Buyers dominate in an uptrend market. Buyers dominate in a bullish market, pushing price upwards. Here's an example. As you can see, price making continuous higher highs and higher lows. This is indicated as an uptrend. This is an indication that buyers dominate. So in the real markets, it would look something like this. Price making higher highs, higher lows, higher highs because it broke the previous. It's a higher high because it broke the previous high, forming a higher low, continued by a higher high. So that is how you identify an uptrend. A downtrend, which is also called a bearish market, price makes lower highs and lower lows. Sellers dominate, pushing price downwards. Example Euro USD. This is this is how you identify a bearish market, meaning that sellers are in control. Price is forming lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs. That is how you identify selling pressure in the markets. That's how you know that sellers are dominating the market. So knowing your trend is already a strategy on its own because I believe there's no strategy that you can trade if you do not know how to identify your trend. It is essential for you to know how to identify your trend so that you may know which market is dominant. Is it either your sellers or is it your buyers that are dominant? This is how it looks in the live markets, price forming lower lows and lower highs. And this is how it will look in the lifetime market. It's not always as clear as this. In the next class, I will show you guys exactly how to identify all these lower lows and lower highs on your live charts. So again, you get a range or consolidation sideways market. These are all the same terminologies used for consolidation markets. So in a range market, right, price moves between resistance and support level. No clear trend, price is in equilibrium, which means there is no form of bulls or bears dominating. They are both dominating at the same time. There is no clear direction, right? So this is an example of a ranging market. meaning that there are no breakouts, there's absolutely no trend available. And this is how it looks in the lifetime markets. This is how it looks in the live markets. Price is simply ranging, it's consolidating within the same area of support and resistance, right? So then you get breakout and reversal. Breakout price breaks out of a range or trend signaling a new movement. Reversal price switches from bullish to bearish or vice versa. So remember, you get a breakout and you get a reversal as well. A reversal price switches from bullish to bearish or vice versa. This is an example of price making continuous higher highs and higher lows in an uptrend and then break structure to the downside, confirming a breakout or a reversal from higher highs going to lower lows, forming lower highs, lower lows, lower highs, and lower lows. That's how you identify a reversal price switching from bullish to bearish in the markets, and vice versa if it is from a downtrend reversing to an uptrend. So how to identify market structure in Forex? Number one, you identify swing highs and swing lows. You may note this down. I'll show you how to identify swing highs and swing lows. Mark the most recent highs and lows. If new highs and lows are forming in one direction, it confirms a trend. Please note this down. If new highs and lows are forming in one direction, it confirms a trend. The same way as we have all these higher highs and higher lows being formed here, this signals that price is forming one direction, which confirms a trend. Price needs to go in one direction to confirm a trend. There's another way that you can also identify structure by means of drawing trend lines. In an uptrend, you connect higher lows with a trend line, right? So this is how it would look like in the live markets. You you connect the higher lows equally, and if you get a breakout of that higher low, that simply means it's a reversal that's about to take place or a breakout. So in a downtrend, it connects lower highs with a trend line. You connect actually lower highs with a trend line, as you see in this diagram right here. Connecting your lower highs, that is also a way that you can identify your trend. Remember, the first thing that you got to do when you come before your charts, you need to know who dominates. Is it buyers or sellers? Class will be over in just a few minutes. So let me quickly go through the last set. You can also use moving averages, but we do not use moving averages here at Boldfx Academy. You can use the 50 EMA and the 200 EMA can help to identify trends. If the 50 EMA is above the 200 EMA, it's an uptrend. If the 50 EMA is below the 200 EMA, it's a downtrend. So you might be wondering, why is all this essential? Why is all this important? Because why the market structure matters in Forex trading. First of all, it helps you determine trend direction for better trade setups. It identifies entry and exit points with higher accuracy. It avoids trading against the trend, reducing risk, assists in using stop loss and take profit effectively. So mastering Forex market structure is essential for making informed trading decisions by recognizing trends, using indicators, and understanding price action. You can improve your ability to predict price movements and enhance profitability. And that's where this class will stop today. If you do have any questions, we have about 8 minutes remaining. We have about 8 minutes remaining in this class. So if you do have any questions that you need me to answer, or anything that you didn't understand properly that I need to go over again, you are more than welcome to send me a message in the chat. So did all of you guys understand what was being explained to you guys? Send me a thumbs up if you did understand what was shared. All right, we're getting thumbs up, meaning that all you guys understood